Good evening, everyone. Thank you for joining us this evening on 2023 Market Outlook. I'm Crystal, the Community Manager at ProsperUS. Let me introduce our speakers for today. We have Tim covering the US market tonight, Head of Content and Investment Lead at ProsperUS, with over 10 years of content experience in the financial industry, including stints at Schroders and the Motley Fool. Next up, we have Mani, who will be covering the SG market as REITs. She has more than 15 years experience analyzing the Singapore property sector. We have Yang Lei from China Galaxy International, who focuses on China consumer equity research and has over 17 years of experience in her field. Last but not least, Billy To, investment coach at ProsperUS. He was an economist at RHB Investment Bank covering Thailand and Philippine markets. As most of you are aware, ProsperUS is a digital investment service catered for the digital natives. We curate educational series so that you'll be able to learn how to invest from the pros. Check out our ProsperUS app on Google Play and App Store today. Follow us on our social media for bite-sized educational content. So without further ado, let's start tonight's session. Tim, over to you.
Thanks, Crystal, and hello, everyone. Thank you for joining us tonight and taking the time out to hear what our team has to say about various global markets. It's been an interesting 2022, as I'm sure everyone can agree on. So without any further ado, I'll just share my slides and start. I think each of us will be around 20 minutes. Hopefully it won't be too lengthy with the slides, but we'll try to shoot through it as efficiently as possible for everybody. Okay, so I'm going to be focusing on US equities and US markets. The usual compliance. Please, don't take anything here as personal financial advice and do your own due diligence for any investment decisions you do make. Okay, so I'm going to just start big picture. I think it's been pretty clear this year that for investors, the macro picture has been more important than it's ever been in certainly my lifetime, and I think in the past probably 40 years. So it's important to understand what's been moving the market. Clearly the Fed, everyone knows that. Everyone knows about interest rates. So let's just take a look back or see where we are so far in 2022 year to date. It's not been pretty. It's down around 16–17% price return in terms of the S&P. And we've remained kind of range bound, between about 3,600 and 4,300 ever since around May. So it's been pretty choppy. There's been quite a lot of volatility. And obviously, I think a lot of the data points that have come through have really driven either momentum to the upside or to the downside. And so metrics such as, CPI prints, employment numbers, these things have really driven markets when they haven't really driven markets over the past decade or since the financial crisis. So I think the era of easy money has slowly come to an end, and now we're kind of experiencing a really volatile time. So what's really been behind this shift? Well, obviously the Fed, right? So the Fed projects where interest rates are headed. So, simply put, interest rates are basically at 40-year highs. They've been hiked at the fastest rate in 40 years, and we've seen inflation hit 40-year highs. So this kind of scenario and this coming together hasn't really happened in 4 decades. So this is going to have really unintended consequences, especially now we're heading into the 2023. And so in terms of where the Fed sees the terminal rate, or where the median rate should be for the Fed funds rate, we're looking at it at being 4.6%, as you can kind of see there. That's been hiked up in September, and is probably going to be hiked up probably again, I'd say, in December when it meets. So at the moment, it's thinking by the end of 2023 that it'll be about 4.5, 4.6%. Well, a lot of the data that's come out since they updated their projections in September suggests that maybe the Fed funds rate is going to have to move slightly higher than that. So the market is still incredibly optimistic about where it thinks rates will end up. We've priced in, basically it's continued to climb where we think the Fed funds rate is going to top out next year. The market's thinking around 5%. You've seen on the right-hand side here, the median view for your appropriate Fed funds rate has slowly risen since the beginning of last year, as inflation has really surprised on the upside and continues to do so. But I think for most investors, we always think about CPI, right? Consumer price inflation. This is what we should be watching. This is the key number. But actually, it should really be core PCE inflation, which for the uninitiated is basically price consumer expenditure, right? So it's a index that the Fed actually looks at a lot more closely than consumer price index, because the consumer price index involves food and energy, which tends to be more volatile. So if you're looking at core PCE inflation, what you tend to see is a lot more of the services sector. So a lot of the wage growth is priced into that inflation number. And as we've seen this year, wage growth has really been driving core PCE inflation, and that's still elevated, right, at a rate that the Fed wants to bring down towards 2%. So on the left, this is a number that if you're looking at momentum, if you're thinking about, what is going to move markets on certain days, inflation numbers at the middle of the month are one of the key ones, right? I mean, that's core CPI in the middle of each month. That's what moves the market. That's not potentially what Jay Powell and the Fed board are actually looking at in terms of the number, but that's what the markets care about. And the first Friday of every month, we've just had last Friday on the 2nd of December was the November jobs report, right? So the first Friday of every month at 8:30, there's also a jobs report that comes out. And that is something that is really closely watched, especially considering wage growth has been pretty hot over the past few months. So talking about labor, I think the labor market is changing. It's clear that in terms of job openings, we're at a multi-decade high. On the left-hand side, you can kind of see job openings in the latest period was actually around 10.2, 10.3 million. And so even though it's come down slightly, since a peak earlier this year, it's still way, way, way above what it used to be in, pre-pandemic and over the past 20, 30 years. And so what's driving that, right? I think it's really a shift in the makeup of the labor market. A lot of people have retired. A lot of boomers have retired during the pandemic. A lot of people have either dropped out due to maybe long COVID or have decided to take early retirement. And so the demand side of the equation is what the Fed is trying to destroy, is trying to bring down, right? Because the supply side of it is still there. There's still a lot of supply in terms of labor. And so, the participation rate has been trending sideways and is still quite low. It's down month on month. This on the right-hand side was the latest, it was October's number rather, and November's dipped down 0.1%. So it's actually at 62.1% as of November. And that's also way below pre-pandemic trends. So labor market's extremely tight. There's a lot of job openings, around 1.7, 1.8 jobs per person looking for employment. So people have a choice, right? People have a lot of options to go to if they don't like their job, or if they want to move away and they want a higher wage. There's a lot more flexibility in the labor market. And so what you're seeing is that play out in the real economy. And we see a lot of the headlines with tech cutting jobs and, Twitter being cut down by however many people, or Elon Musk laying off a lot of people. But we forget that actually tech only makes up around 2% of the US labor market in terms of numbers of jobs. It's actually relatively meaningless. And so what is really driving this wage growth is hospitality, is travel, is consumer services. And these jobs in those sectors are still red hot, and they're still hiring. So it's an interesting labor market setup heading into 2023. In terms of where we're headed, I think the economic signs do point towards a recession being inevitable almost, but how deep that recession will be is obviously still in question. Inverted yields between the 2-year and the 10-year is at its deepest since probably the early 2000s, and so this is an impending recession sign. It's being quite obvious, I think, in the past sort of few months that earnings revisions are coming down, which I'll get to in a minute, and this is going to really pressure the economy in the US. So I think to sum it up for people on the Fed side, it's that the first question's really been answered, right? There's a lot of talk about the Fed starting to slow down rate hikes, which is great, and there's been a lot of market enthusiasm about that. That's great, but the two questions after that have still yet to be answered. And as the Fed likes to remind us, it's all very data dependent on where inflation is, where wage growth is, where a lot of metrics are for the economy. And so number two is, where will the Fed funds rate top out? Where is that at the moment? A lot of the market is thinking around 5%. That may change. That could be topping out at 5.5 to 6%. We'll start to see over the next few months whether this one-off inflation number or one or two inflation numbers in a row actually turns into a trend, or if it's just an anomaly. And then third, how long will it stay there? That's another key one. The neutral rate back in 2012 was thought to be around 4%. So neutral rate means it's just the right rate in terms of the Fed funds rate. It doesn't stimulate or it doesn't cut economic growth. That's been taken down over the years to about 2.5%. And now the Fed, I think, is probably going to have to raise that. So where would the Fed be comfortable with the Fed funds rate, staying for maybe 6 months to a year, to make sure that inflation is defeated? Because at the moment, the Fed is really concentrating on inflation and the economy is taking a backseat. So where are the opportunities? I mean, there's a lot of the macro, but what does that mean for investors in terms of the actual opportunities? And obviously, there's a lot of risks and a lot of pitfalls which we'll get to. But there are some opportunities, and there are some places that you can still be invested in going into 2023 and beyond. I think for me, I like to take a look at history, see where we can learn lessons. Obviously, it's not exactly going to be the same how it plays out, because the confluence events this time is specific. It's specific every time. It's very different every time, but in a ways there are similar patterns from before, and you can kind of see in past recessions or past bear markets where are the best places to be, right? So in 2008, this is just a really good overview of all the Vanguard sector ETFs that follow specific sectors within the S&P, and then at the top you've got the broad S&P 500 VOO, which tracks the S&P, right? So in 2008, we kind of see everything got hit massively. It was just Armageddon, right? It felt like Armageddon. But in terms of relative performance, it was no surprise to see consumer staples, utilities, and healthcare, which are highlighted in yellow there. They're the top three performing. They were still down, obviously ranging from 28% to 17% or so. But they did a lot better than the actual broader index, and obviously tech and financials. So it's important to remember where are the gains, or where are the areas that investors can be invested into heading into a potential recession. And healthcare is one that is easy to find a lot of great quality companies that have really solid earnings profiles. Will likely see earnings hold up. Healthcare is important. Everyone needs it. Everyone uses the services behind either instruments, or they use pharma or medicine. So these types of companies tend to perform pretty hold up better than other companies relative to in a recession. And consumer staples as well. Obviously, everyone needs to eat, needs to buy goods and services, and utilities, because it's a very, very dependable area for income as well as electricity use. People need to use electricity, need to use their water supply. So it's very obvious. But I think for me, healthcare has been really one of the most consistent performers, because in the past sort of 8, 9, 10 years, it's been in the top 3 the most out of any sector, you can see. So in 2011 to sort of 2015, it was in the top 3 sectors each year. And that was in obviously a very good bull market, but it does have some element of downside protection as well for investors, which is crucial. This is a bit more focused on the global makeup, S&P Global Benchmark Index. You can kind of see from a global perspective, you have a lot of European pharma as well. But during the global financial crisis, these kinds of sectors tend to perform relatively well versus the global benchmark. And so it's no surprise that these 3 sectors are currently quite popular with investors. Whereas I think consumer staples looks expensive. I think healthcare and utilities actually offer decent value at this point in time. So that's been backed up by the outperformance, right? We've seen the S&P through last week down about 16-17%. Utilities has performed second best to energy. Obviously, energy has surged based on the oil price and earnings, and so energy has really been an outlier this year in terms of its return. But I think that's come from the invasion the invasion of Ukraine from Russia and the war there, and then all the supply issues that we've also had to deal with. So if you exclude energy, it's actually been the traditional ones that you'd expect, right? It's been basically utilities, healthcare, and sort of consumer staples that have performed the best. So it's been no real surprise in that year-to-date performance. But I think if heading into the last quarter and the earnings season, it's clear the market isn't actually that cheap on a historical basis. We're looking at a P of around 17.5, around 17 to 17.5 on a forward earnings basis. That's not super compelling. I mean, if we think about past bear markets and I guess recession bear markets, you're looking at a forward P bottoming at 10 to sort of 12 times earnings. So we're not at really compelling valuations right now to go big into the market. And earnings estimates, they keep getting revised down. So sell side analysts, we love to, there's a lot of optimism behind earnings estimates generally everywhere. S&P has, if you think about Q3, is actually negative growth year on year. If you exclude energy, energy really held up the index in Q3. And so this is earnings estimates coming down over the past 3 months for Q4. And so it's actually just turned negative last month. And so I think it's starting to hit home how serious, or not serious, but rather how likely it is that there will be a recession. It's just more about, will it be deep and will it be painful, or will it be a shallow one, and the economy can get back to growing sort of within 12, 18 months prior, after earnings kind of bottom. So we'll see how that plays out. But it's coming from an extremely high base, right? I mean, January, there was a lot of optimism for earnings going into this year, and you can kind of see it's dropped down to 4%, but there's still a gap between earnings growth and where the market is right now. So the market is really, in my estimation, not really pricing in a recession in terms of earnings at this point, because if there is going to be a recession, then earnings growth is going to turn negative. But yeah, we have further to go, right? We have further to go. We can kind of see on the left-hand side, the S&P in terms of the index has fallen, but estimates for next year are actually still positive. As I've just said on the prior slide, they still forecast 4% growth. So it doesn't really add up in terms of where we're seeing the market headed in terms of earnings estimates versus the actual price action of the S&P. And if you think about recession-linked earnings declines, they're pretty deep, right? So recession is just does tend to take a hammer to earnings. It just depends on what level of sledgehammer it's going to take to earnings. And earnings estimates at some point, if we do enter a recession, are going to have to turn negative, and sort of match reality as well. So as I said, only about down 17% or so far in 2022. Average loss of bear markets is not pretty. So even though it's felt a bit tumultuous this year and it's felt a little bit intense, it's actually not been that bad from a high, but it's felt very, very intense because of all the uncertainty and all the inflation and interest rates rising so quickly. So this is something to bear in mind, right? We've had at least one bear market rally, and then it's come down to a new low, and then we're seeing sort of a mini rally again. So this is behavior of the stock market that has been evident most recently in 2007 to 2009. So I wouldn't be surprised if we do enter a recession for the S&P to drop down at least another 10-15%. And bear markets, as we know, they can range from very quickly in 2020 for the pandemic, which was the shortest on record, to a lot longer in terms of the tech bubble rather, in 2002 to 2002. Okay, so I think this is what investors want to know. Where do we want to be in 2023? I think cash is going to be one that we should be building just as a dry powder position, just to ensure that we have something there to deploy when there is opportunity, because I think there will be opportunity in the next year. If you do want to be invested, I really think defensive sectors continue to hold an appeal. Areas such as healthcare, utilities, real asset owners, right? So utilities are one that own a lot of assets. They own infrastructure, they own a lot of clean energy transition, renewable energy assets that are part of the clean energy transition. And we've kind of seen a lot of government support as well so far this year, especially in the US with the passing of the IRA, the Inflation Reduction Act. And that's going to allow a lot more subsidies and incentives to feed through to clean energy producers. And so one of the benefits of infrastructure, or at least asset owners, is that a lot of their either power producing or service producing infrastructure is tied into long-term contracts, and they're usually tied to CPI, right? So they're usually sheltered from inflation to a certain degree. So you've got an inflation-linked revenue stream, which also pays back to investors. And so infrastructure has been one that I think a lot of investors have seen rise in demand, and I think that's going to continue on into next year. And that's across the board, right? Real assets. I think Money will touch on REITs later in Singapore. They've had a pretty bad year in the US. I think they're down around 27-28%. So they've actually underperformed the S&P. But I think once we start to get some certainty on interest rates and where we're headed, and property owners and REITs start to understand what their financing structures and what they'll need, then I think real assets they do offer an inflation hedge, because they can continue to raise rents and in line with inflation or even higher. So this is something that I think we'll see over the next couple of years. And as I said, real assets, they're still in demand privately. This is taken from NAREIT. It shows different inflation scenarios, right, for REITs. And so obviously private markets have done very well because they haven't had mark-to-market things. So there's a lot of investment into private real estate. But if you think about the public side of real estate, think about REITs, it's still a very big market in the US. And they've outperformed the S&P when we've been in higher inflation environments or moderate inflation. And so the NAREIT considers high inflation anything above 7%, which we're currently in. And even moderate inflation, you're still going to get a pretty good income return from REITs based on history. So once REITs start to bottom out, I think in the US, and we start to see inflation maybe settle at a higher rate, I think real assets are really going to come into their own and prove their worth to investors. And then finally, I'm just going to end, on the last few slides with dividends. I think dividends have really been an important part of total returns for investors over the past 7 or 8 decades in the US. If you look at the average, it's actually been 41% if you're thinking about compounding returns. So it's incredible. And 2010s were one of the lowest, right? The era we've just gone through with technology stocks, with high growth stocks really doing very well, and the return of the index, total return of the index, not really coming that much from dividends. That may actually change, right? That may shift in the next decade to come, because I think in terms of reliable income income tied to inflation. I think these are going to be really important characteristics that investors are going to value, especially in a higher inflation and a higher interest rate environment, which may stay elevated for some time. I mean, little known fact, the utilities sector in the utilities sector in S&P 500 has outperformed the Nasdaq on a compounded total return basis since the Nasdaq was formed in the 1970s. So utilities have done exceptionally well over the past sort of 40, 50 years. It's not really that well known, but it's something that investors should just recall, because it's the power of compounding and the power of dividends that really delivers those returns to investors. Thanks. Q&A will be at the end, but if you do have any Q&A for myself or anyone else in the following presentations, please just pop them in the Q&A box that we have on Zoom, and we will get to them at the end. So thanks everyone for that, and I'll pass it back to Crystal.
Thanks, Tim. So next up, we can hand the time over to Mani, who will be covering Singapore market as REITs. Mani? Mani, you are muted.
Sorry. Thank you, Crystal. Good evening, everyone, and thank you for taking time to be with us today. I'm going to do a little different today. I'm just going to talk about S-REITs because I think it's a sector that we've been getting a lot of attention and questions. So without further ado, let me just share screen. Okay. Okay, so without further ado, let me just share with you some thoughts on the REIT sector. Oops, I think Crystal, I think we have a technical glitch. It's not loading.
Okay, sure, no issues. Let me just give me a second. I will share your slides.
Thank you. Okay, this is the performance of the S-REITs year to date. And so far, like what you've been hearing from Tim as well, the S-REIT sector has actually been underperforming the broader Singapore market. It's down about 16% year to date, and only the second last underperformer compared to manufacturing. But interestingly, if you look at on a month-on-month basis, the S-REITs actually did improve by about 2.6% just in the month of October. So I think this is after the big decline in S-REITs, on the hawkish Fed rate tone in terms of interest rate. So next page, please. So if you look at how the S-REITs market has performed year to date, we compare it against the other ASEAN and Asian REIT markets like Malaysia, Japan, and Australia. I think the best performing markets in the region are basically your Malaysian REITs and your Japan REITs, which has only declined by low single digits compared to the double digits that you saw in the other markets. Next page. Next page, please. Okay. This is gives you a snapshot of the monthly flows into the S-REITs, both from the institutional investors as well as from retail investors. And we have seen so far is that year to date, the flows into the S-REITs have been actually quite muted. So up to November, there has actually been an outflow from institutional investors of about roughly $1 billion. While retail investors saw an inflow of close to $1.2 billion. So net, it was a net inflow, but a minimal net inflow. But I think you also see where the other sectors are getting attention from institutional investors. So overall institutional investor inflow was close to $1 billion. And they are, they have invested in the other sectors, for example, the banks and the capital goods. So these are some of the sectors that have been capturing attention outside of the REIT sector. Next page, please. I think interesting to share what had happened in the recent REIT results that spark off a bit of sell down in the REIT sector on top of the hawkish Fed tone in terms of interest rates. So I think what we saw from the REIT results was that in terms of revenue, the top line was pretty strong. You do see good rental reversions coming from industrial REITs of 3 to 11%. Even the office REITs are generating between 6 to 9% positive rental reversion. And the retail REITs are also starting to see more of a rental uplift on reversions. Not surprisingly, the hospitality REITs have a very strong quarter of results. Basically, CDL Hospitality Trust saw a 44% jump in the 9-month revenue due to very strong RevPAR performance from the rebound in global travel. The only other thing to observe is that in terms of cost management, the office and the industrial REITs, have indicated that they are starting to raise service charges. And this will start, from the fourth quarter going into next year so that they can actually pass on some of the higher utilities costs. The implication of this is basically that the NPI margins for the REITs would be partly, preserved because of the ability to offset some of the costs. In terms of the balance sheet, gearing was steady. And the average debt hedging ratio was also relatively stable at 74%. I think the key surprise in the REITs results, and it was a negative surprise, was the faster than expected rise in interest costs for the S-REITs. So on a quarter-on-quarter basis, we saw between a 20 to a 50 basis points increase in average funding costs. And most of S-REITs are indicating that they do expect further upward revisions in funding costs going into next year because of the rising interest rate environment. So overall, the recent REITs results season saw us cutting the REITs earnings by 2 to 16% and also cutting our target prices on higher than expected interest costs. So I guess this kind of also reflected what Tim was saying earlier in terms of what's happening in the US side as well. Next page. Yeah, this is again just a breakdown of our earnings changes and our target price changes. Next page, please. So where do we stand today? So if you look at where S-REITs are trading at, they are offering about 6.25% dividend yield. And this is roughly about midway between where the region is trading at. In Thailand, it's in the high 6% dividend yield, and the lowest is in Japan, where it's about 3.5%, closer to 4% yield. Next page, please. So where do we go from here? As we mentioned, we are getting a bit more investor attention and questions on what do we think of the S-REIT sector and where do we go from here. So firstly, let's look at where valuations are. So S-REIT today is trading at close to 0.9 times price to book. So at the -1 standard deviation. So not expensive in terms of NAV, and also at 6.2% yield, it's roughly back to the average. So as what Tim was saying in his presentation earlier, even the US REITs and the Sing REITs, they're not. It's not at the cheapest valuation to date. So going into the fourth quarter and into 2023, I think what the key investor concerns for S-REITs are basically, can S-REITs deliver growth going into 2023, given that interest costs are expected to rise? We are also expecting slower growth. Base case for Singapore is not recession, but slower growth. So this could dampen rental reversion. And also with high interest costs, can S-REITs acquire to grow inorganically? So I think these are the key questions that that people have been asking. So we think that the S-REIT recovery in terms of the performance of the sector this time around will be uneven going into next year. There will be a lot of attention that will be paid to balance sheet, especially in terms of how do they manage their funding costs and manage their debt maturity profile and also hedging of their debt. And those with strong debt covenants and ability to deliver DPU growth, I think will certainly hold up better in this environment. Next page, please. Yeah. So, okay, let's take a look at this chart, how S-REITs performed during previous interest rate hike cycles. As you can see in the latest data, the yield spread between the 10-year government bond yields in Singapore and the 3-month, the short-term rates is actually in the negative territory because the yield curve has been inverted. And this is one of the deepest inversion, I think, since back in 2006, when we saw a slight negative yield spread in terms of the long and the short rates. But if you look at essentially what had happened in previous rate hikes, I think this was one of the sharpest rate hikes in 2004, where we had 425 basis points, and also in between 2015 to close to early 2018, we had another sharp surge in rate hikes. So what had happened during this period is that when the yield spread started to narrow, we saw the REITs starting to perform. This time around, I think one of the key issues have been very high inflation, which is why there's been a bit of a disconnect. But I think given the signaling from the Fed that if we see another 50 basis points in December and potentially another rate hike in the first half of 2023, and essentially we could be closer to the end of the rate high cycle compared to what it was, say, a year ago. Next page, please. Okay, so I think this is another interesting takeaway is that we all talk about how inflation is good for real estate. Generally, yes, agreed. Inflation is good for real estate, but too high and too sharp an inflation hike is not good. And you see that basically the light blue line is inflation and month-on-month inflation in Singapore, and the dark blue line is the REIT index. And every time we have a sharp spike in inflation, the REIT index tends to underperform. We saw this here, and we also saw this here until inflation peaked. The question is, and the reason is because when inflation rises too fast, landlords cannot catch up in terms of pricing their rents. So generally, you can't pass on the inflationary pressures immediate effect, especially in Singapore when rental structures are not inflation linked. So in that sense, there's going to be a lag effect, and that is why I think the REIT market has been choppy as well. Next page. Yeah. This just shows you how the bond yield, 10-year bond yield, performs in terms versus inflation, and they're quite in tandem. Next page, please. Okay, given that we expect interest rates to continue rising, and in this page you see that interest rates have actually spurred very sharply towards the end of the first quarter and going into the third quarter. So what has happened is that at this kind of levels that you are seeing towards the third quarter, when S-REITs refinance their debt in the fourth quarter and into 2023, we do expect that they will be refinancing into the higher rates, and that debt costs will continue to increase. Next page, please. So what is the impact of rising interest rates on S-REITs? So I think generally what we are seeing is that as far as gearing is concerned, it's about 37% on the average. So not too excessively high. And there is about another 4% of debt in the S-REIT sector, and about 14% of debt to be refinanced up to next year. And REITs are generally still very well hedged in terms of 74% of their debt hedged into fixed rates. But nonetheless, there is a 25% that is floating. And I think as they refinance and also due to the floating portion of the debt, you would see interest costs rising. Next page, please. Okay, so in this table, what we're trying to show is that another metric that people look at or investors look at is basically interest coverage ratio, which is basically your EBITDA divided by your cash interest expense. And if you look at generally, the number is quite high, anywhere between the 3 to even as high as 18 times interest coverage by Parkway Life REIT. But I think the thing to note is that there are two REITs to look out for, which is Lendlease Global Commercial REIT, where the interest coverage ratio stands at 2.3 times, and for Suntec, it's at 2.5 times. And under the MAS REIT guidelines, if you have an interest coverage ratio of less than 2.5 times, then your gearing ceiling for the REIT will be kept at 45%. Otherwise, the gearing ceiling can actually go up to 50%. So what it means is that in the longer run, until and unless they can improve this interest coverage ratio, the ability to leverage on debt to grow, to buy assets will be kept at a gearing of 45%. Okay, this is another table on the rising interest rates. The key takeaway from this table is that basically we talk about how funding costs for REITs should increase. So in this table, we just wanted to show that this is the funding cost for S-REITs on the second column as at the third quarter. And this on the right-hand side column, this is what we think funding costs would look like going into 2023. And you can see that basically funding costs could go up by anywhere between 20 to 60 basis points. So our current estimates have assumed about 10 to 40 basis points. So I would say that going into the next quarter reporting season in January, I think you will probably see the street or analysts revising their earnings down to accommodate the rising interest costs. Next page, please. Okay. The other impact on higher funding costs is also that valuation cap rates may come down. So what happens if valuation cap rates valuation cap rates increase? So what will happen if cap rates increase? This will potentially lead to lower capital values, and the NAVs of the REITs could be impacted. So in this page, what we're trying to show is that what if asset values come down by 5%? Which of the REITs is at the most risk of hitting their gearing ceiling? So again, Suntec, if portfolio value goes down by 5%, they'll be hitting the 45% gearing ceiling. Okay, so basically they will be unable to take on more debt to grow if they hit this level. I think the other REITs are basically L-REIT. I think the risk is only if capital values go down by 15%, and as well as for Manulife US Trust. I think generally the REIT sector still stands fairly well, even if asset values come down by anywhere between 5 to 10%. Next page, please. Okay. So I think the other question that we have been getting is that share prices have come down quite a bit, especially in November and into early December. So the question that we get is, what is actually reflected in the share price? How much of the rate hike and also, of the lower earnings has been reflected in the share price? So basically, this table, if you look at the right-hand side column, this shows us what is the additional risk-free rate that is priced into the share price. So for example, our assumption is for a 3.1% risk-free rate for CapitaLand Ascott Trust. but the market actually has priced in about 4.8. So they're pricing in an additional 1.6 or 1.7% in terms of cap rate. So much of that expected rate hike, I would say, that is in the share price at this point in time. Next page, please. So going into 2023, what would be the strategy for S-REITs? I think market will continue to be on the lookout for Fed's stance on inflation and interest rates. I think in Singapore, the government anticipates that inflation will remain high until the second half of 2023. And so we think that S-REIT performance will remain choppy, especially in the first half of the year. And we think that an interesting time to look at REITs would be what will be the result season in January, what results would the REITs deliver, and what would be their guidance going forward as far as funding costs. We think then that, you know, if share price continue to decline, there could be interesting buying opportunities going into that period. Of course, the downside risk to our assumption is basically if inflation continues to remain stubbornly high and interest rates will remain high, and that means, you know, a protracted high era of funding costs for REITs that could impact performance. But nonetheless, we think that much of that has been priced in. But if you're looking for entry opportunities, watch out for that for the upcoming result season to see also how what would analyst earnings cut look like and what would valuations be at that time. In terms of stocks that we would look out for, basically we still like CICT and A-REIT. Those would be our picks in the S-REIT sector. Next page, please. Yeah, so this is just a comparison table of our REIT coverage. And next page. And I think that brings me to the end of my presentation. So I'll pass back over to Crystal.
Thanks, Man-Yi. So if y'all have any questions on S-REITs as well as the US market, do pop them in the Q&A box. So up next will be Yang Lei, who will be sharing with us on China consumer equity.
Hi, good evening, everyone. This is Lei. I'm covering China consumer sector, internet sector, and also education names. So today I will give you the general picture of China consumer and the e-commerce sector and the catalyst and the outlook for next year. Let's go to page 2. Yes, actually currently, although the share price of China consumer internet names have already started to recover, but the fundamental actually is still quite weak. For the third quarter results, we only see a weak consumption recovery in third quarter. Most consumer companies under our coverage reported relatively weak third quarter results, mainly due to the COVID impact, weak macro, and high cost pressure. Only 4 companies among the 20 consumer names under our coverage reported the third quarter results above our expectation. The remaining 16 companies actually reported the third quarter results in line or below our expectation. And also currently, most companies still have taken a conservative view for the fourth quarter outlook. But we see some catalysts for next year. One is the COVID policy opening in China, which could be quicker and earlier than people expected. And secondly is the cost pressure reduction in next year. So we still maintain the overweight rating for China consumer and the internet sector. Our topics are Maotai, Qingdao Buri, Lining, Proya, and Trip.com. And for the internet names, we like Tencent, PDD, and Meituan. Okay, let's go to page 5. Page 5, yes. For the October macro data, actually China reported a quite weak consumption data for October. The total retail sales decreased by 0.5% in October versus an increase of 2.5% in September, indicating a slowdown in the overall consumption recovery. And the online sales continue to grow faster than the offline sales and taking over market shares. Total online retail sales grew by 22% in October versus 14.5% in September and 8.7% in October. So online sales continue to take over market shares from offline channel. And the online sales contribution to total retail sales in China increased from 29% in September to 34% in October. The catering sector continued to be weak because since later September, we have various COVID resurgence in different places in China. And back to that time, we still have lots of lockdown areas. So the China retail sales of catering declined by 8.1% in October versus a small decline of 1.7% in September and an increase of 8.4% in August, mainly due to the COVID resurgence. So we expect the catering service to gradually recover along with the easing of COVID policies. Let's go to page 6. Page 6 is about the November 11 online shopping festival in China. This year, the November 11 online shopping festival is a bit weak versus the last couple of years. The total GMV in China only grew by mid-single digit versus 12% last year and over like 30-40% for last couple of years. For the largest e-commerce platform, Alibaba, the Tmall and the Taobao achieved the flattish GMV growth for November 11. And for JD.com, the second largest e-commerce platform, achieved the mid to high single digit GMV growth. And we see some categories grew faster versus other categories like cosmetics, home appliances, healthcare products, and etc. And the live broadcasting platforms like Douyin is gaining market shares. Also, Kuaishou also gaining market shares. We think the live broadcasting platform has become more and more important in China e-commerce sector. Okay, let's go to page 7. On page 7, we will give you some updates for the China COVID policy relaxation. In November, Chinese government announced 20 new measures for the COVID policy. For closed contents, COVID control policy changed from 7 days centralized quarantine plus 3 days home quarantine to 5 days centralized quarantine plus 3 days home quarantine. And the government also removed the COVID control for secondary contents. The government emphasized to increase the vaccine ratio, especially for older people. Currently, for older Chinese people, the vaccine ratio for at least 1 dose is around 92.5%. And for at least 2 doses, the vaccine ratio is 90%. But the vaccine ratio for boost is a little bit lower at 58% in China. For older people above 60 years old, the 1 dose ratio is 90.7%, and 2 dose ratio is 86.4%, and the booster ratio is 68%. The average vaccine ratio is actually not very low, but the booster ratio is still relatively lower. So the government recently re-emphasized and launched new vaccine products. Secondly, the government also indicated to increase the ICU beds in the overall hospitality system. The government targets to increase the ICU beds ratio to about 10%. From currently only 3% over the total beds. And the number of beds in healthcare institutions in China was 6.7 beds per 1,000 citizens, which is still lower than the developed countries, and also lower than Singapore and Japan and other developed countries. So this is also one important focus for the government to increase the healthcare system, to increase the ICU beds ratio. And China does not emphasize zero COVID policy anymore, but transfer to be more practical to focus on how to improve the vaccine ratio and how to cure the patients. And then the market rumor says maybe in the next couple of days, maybe tomorrow or the day after tomorrow, China will announce further 10 new measures to further relax the COVID policy. The government also opened the package tours for cross-provincial traveling. People now need to show the negative PCR cases within 48 hours for cross-provincial travel. And also, we expect China will fully open the COVID policy in early next year. And the likely policy relaxation will benefit the overall consumption demand, especially the tourism, catering, and the sports sectors. Also will benefit the catering-related consumption like beer, and condiment consumptions as well. In recent couple of days, various local governments also announced to cancel the PCR tests and also to open the public places. Okay, let's go to page 8. Page 8 is give you some picture for the recent positive cases in China. Actually, since late September, the positive cases are increasing in China very quickly. And we estimate that over 60% population in China live in a city with at least one high-risk area. And among the these cities with one high-risk area, about 38 cities have more than 100 high-risk areas. And the total GDP of these cities accounts for about 24% of China's GDP. And the population of these cities accounts for 20% of the total population in China. And the 4 cities of Beijing, Chongqing, Inner Mongolia, and Zhengzhou each have more than 1,000 high-risk areas. And these 4 cities are the very important economy areas in China, and with GDP accounts for 7% of the China total GDP and 5% of China's total population. So this is also give you some idea, like if China continue to adopt the zero COVID policy, the cost on economy, financial is huge actually. So this is also one important reason for the government to open the COVID policy. Okay, let's go to page 9. As we mentioned, for the e-commerce sector, we recommend the investors to bottom fish in China e-commerce sector and the internet sector. The share prices of e-commerce players have dropped significantly year to date. The biggest drop was Bilibili with about 62% share price decline, followed by Tencent's 34% and Alibaba's 29%. So we believe now it's a very good opportunity to revisit China internet sector, given the likely normalized regulation environment and the e-commerce players' successful cost saving and the business streamlining measures. Recently, all the e-commerce players just reported their third quarter results. And all the e-commerce players announced the non-GAAP net profit above our expectation for the September quarter, mainly due to the effective cost-saving measures. Among the major players, Alibaba's China commerce revenue dropped by 1%, and the JD Retail's revenue grew by 7% for third quarter, indicating these top two players are actually losing market shares. PDD is gaining market shares with 65% revenue growth, the highest among the peers. Meituan is also gaining market shares since its low to mid-teens order delivery, order number growth plus the increasing average order value in third quarter outperformed the 1.5% growth for China catering sales. And all the e-commerce players have taken various cost control measures and streamlined new business this year and achieved very good results. We expect this strategy to pursue high quality growth will sustain in the next 2 quarters. But if the domestic consumption recovers in second half next year, we expect the e-commerce players to increase their sales and marketing investment to drive up the top line growth. Currently, most of the e-commerce companies still have a conservative outlook for fourth quarter revenue growth. So we expect the fourth quarter revenue growth for most e-commerce players actually will slow down quarter-on-quarter basis. And we also mentioned that we expect the regulatory environment for the e-commerce sector has normalized, which should trigger re-rating for the sector. In April, the government resumed the approval of online game licenses, and so far it has approved the 314 new licenses. Also in November 22, the government publicly announced the issue for minors to play online game has been largely solved. Since currently more than 70% of the minor game players only play online games for less than 3 hours a week. And also recently, the government approved a joint venture between Tencent and the China Unicom to develop the edge computing and the cloud business, and also Tencent's investments in Samsung Insurance. All these measures indicate the government has loosened the control on the e-commerce sector, and the overall regulatory environment has turned to normalized. And the valuation-wise, currently most e-commerce players are trading at a discount of close to 1 standard deviation of 1 year forward PE and PS. Alibaba is trading at 12.8 times and 10.6 times FY22 and FY23 PE, offering the cheapest valuation among the coverage. And lastly, on page 10, we listed the major soft commodity prices, which is very important for the China consumer sector. And you can see from the table here that in recent 2 to 3 months, the palm oil price, PET price, sugar price, and raw milk price have started to correct. and this will benefit the consumer companies to reduce cost and to improve the GP margins. We expect the cost pressure to reduce in next year, and these more cost-sensitive names like instant noodle player, beverages player, tissue player will all benefit from this cost reduction trend. Okay, that's the overall picture of my presentation, and I will take any questions at the end of this session.
Thanks, Yang Lei. Next up, we have Billy covering the Malaysia market. Billy, over to you.
Yep. Let me just share my screen first. Okay, so before I start talking into Malaysia, let's just talk a bit on the global front a little bit, because I saw that we have it's always hard to be the last speaker when all your three speakers have done basically all the necessary. So I'm just gonna basically pick up what was missing that was not mentioned. So basically 2022 has been a tough year adjusting to the new normal. So initially I wanted to share a video with you guys, but because of the lagging of the internet, I decided not to. So if you look at the first slide here, you can see that global stock market is mostly in the red this year. So you can see S&P 500, FBM, KLCI, Hang Seng, whether it's in Europe, in Asia, in US, is in the red, except one of the standout is Singapore Straits Times Index. Of course, I think the best performer in the region was Jakarta Stock Exchange. So that's also an outperformer. So basically what happened is that we've been moving from we've been shifting from a pre-COVID to COVID, and then now we are moving away from COVID. And along the way, we are facing with a lot of disruptions. First of all, of course, I think Tim and the rest have mentioned about it, the rising interest rates, and of course, the global persistent inflationary amid rising commodity prices. But I guess what's also missing was the prolonged Russia-Ukraine war that was mentioned, that started at the beginning of this year. So if those of you who follow ProsperUS, you know that we actually talk about one of the weapon manufacturer, Lockheed Martin, at the beginning of this year, and the share price of the company has jumped by 26%, as of I think yesterday. So that just shows, you really need to capture the trend, especially when a lot of the market is being affected by the macro environment. And then, of course, there's also the shortages of semiconductor chips, the China COVID-0 policy, and of course, the US-China geopolitical tension. I'm just going to quickly go through all this before I go into the Malaysian market. Now, what's really the concern is the soaring global debt costs. If you look at the chart on your left-hand side, you can see that the world has added about 80 trillion in debt over the last decade. And these interest costs are going to go up. It's going to be expensive. So there will be an impact on, the market. So basically, there is a big jump in terms of your interest rate, and that will affect how you, manage your costs and your expenditures. If you look at the extent of damage, it really depends on how high the central bank will push for interest rate hikes. So you can see on your left-hand side, basically Bloomberg has what the rate hike that's already been done, and what is expected is basically more or less in line with what the rest of the speakers have talked about. And of course, if you look at it, it's not just in the United States, it's basically global everywhere. Whether it's in Malaysia, it's in Thailand. So I remember when I was covering Thailand, interest rate was going to zero, and today it's started to raise interest rate as well. But we are not just facing with that. Another issue that we are looking at is the US Fed shrinking of its balance sheet, which could fuel liquidity risks in 2023. So if you look at the chart here, you can see that the Fed balance sheet has jumped up significantly during COVID, from about 4 trillion all the way to 7 trillion, and it has gradually moved up to until 9 trillion at the beginning of this year. So the Fed has started to unwind some of this balance sheet, and it has dropped to 8.6 trillion. And recently in September, it has announced that it's ramping up the pace of quantitative tightening to reduce 95 billion per month in its balance sheet. So that's quite a lot of liquidity that will go away, and that will have an impact on the market as well. Now, consumers are definitely going to get squeezed because a large portion of our household saving earnings will go to debt repayment. I'm sure most of us already felt it if you have owned a property or something. So you already felt that you're paying more for your monthly installment. So that's how the market will affect, day-to-day people, and this will have an impact on consumer stocks as well. But of course, on the bright side, the US household excess savings is at 1.7 trillion. Now, this excess savings is basically during the COVID period when the US pushed for its fiscal stimulus. So I think at the beginning of this year, last year, second quarter last year, it go up to above 2 trillion, and it came down to 1.7 trillion, but it's still a lot, which would help to sustain some of the consumer spending and cushion the decline. Now, a bit on the investment themes in US. Now, basically, I believe that, if you are into long-term investing, consumer stocks will be there for you because there is a sustained consumer spending, and these boys will eventually come back. The likes of Coca-Cola, Pepsi, they will always be there. But you also want to capture some of the trend that I talk about, which is why I highlight Lockheed Martin at the beginning of this presentation. So you basically see that there is an infrastructure spending in US because of the Infrastructure Investment and Job Act that is being passed, which will direct 1.2 trillion to US infrastructures. So the material players, the construction players will benefit from this. Then there is also the clean energy and electric vehicles. This is coming from the Inflation Reduction Act, which is built on the Infrastructure Investment and Job Act, which will direct 370 billion to clean and EV players. Now, there is also the structural growth story for tech as digitalization continues to pick up. But of course, like what most have said, valuation will come down significantly as the US quantitative tightening picks up. Now, there is also the impact of the globalization that we need to look at, given the US-China relationship. So if you look at it, US actually passed the CHIPS Act, which will direct 52 billion subsidy for their semiconductor players. So the US semicon players will benefit from it. But it's not just that. If you've been following the news, the European is also trying to pass their European CHIPS Act. So it just shows that countries, companies, they are more concerned about supply chain and the fact that, you can't just put all your manufacturing in a single country and expect you don't have the supply chain risk. So we are seeing that now. And all right, so with that, I will just move to Malaysia. Thankfully, for those of you who are interested in the Malaysian market, we are less affected by the macro environment, more so with the domestic environment. Now, I think I'll just go ahead and say that Malaysia is probably going to be more affected by the results of the GE15, the recently held election. And the question is, does it provide the clarity and certainty for investors now that Anwar Ibrahim has become the Prime Minister? Now, the cabinet has also been announced, so I'm sure if you've been following, you will know who is in the cabinet. So it's a mixture because of the fact that it is a unity government. Now, the problem with the election and with this for investors is that there is no clear winners and losers in G15. It's basically a rather mixed result with Pakatan Harapan, Dato' Sri Anwar Ibrahim being the Prime Minister. Then there are lingering concerns over the fragility of the potential alliances. PH with 81, and you can see they're relying on the number of seats coming from Barisan Nasional, which is 30. And so anytime if there is a swing, you would probably see re-election or change in government again, which is the major concerns for investors. So some of the key events to watch out for is the cabinet lineup. I think we have seen that, and whether you like it or not is your preference. Personally, at least we see that the government is able to come up with the cabinet. The first sitting in Parliament on 19 December will be very important because there is a talk on the vote of confidence. So this is the time when you have to see if Anwar Ibrahim can get the numbers that he needed. And then there's also the budget that will be tabled again. So how will the budget, how will it look like? Is it going to be an expansionary budget? Where will the spending goes into? Then, of course, the UMNO party election. Bear in mind, UMNO is part of the coalition, part of the party, the major party, in fact, within Barisan Nasional, which will play an important role in terms of who remains as the government. Then there is the state elections in Penang, Selangor, Negeri Sembilan, Kelantan, Terengganu, and Kedah. So all this will basically affect how stable the government in Malaysia is. And I think that's probably the major concerns that investors are looking into as compared to the macro environment. Now, the potential impact on the economy, I think the slide is a bit outdated given some of the recent development, but it's still more or less there. So I think the fact that the PH-led government is against GST, so we will not see this coming up. But if there is a need to boost revenue on the fiscal front, then there's probably going to be a revival of prosperity tax, which will affect some of the big names like your Maybank and your bigger players. Then there's the institutional reforms, which will not really affect the stock market. It will focus on issues related to corruption, institutional integrity, and transparency. So basically, this is your trying to compete with the rest of the market in the region, like your Indonesia, your Vietnam, your Singapore. So which kind of policy will attract investment to come into Malaysia? Now, I think this is very important, especially on one front, where I talk about the deglobalization due to the US-China relations. So whether manufacturers will choose to come to Malaysia or not, especially on the semiconductor front, I think that's going to play a very important role. So we probably want to keep an eye on news flow on that front. Then there's the support for cash handouts. I think this will help to boost your consumer stocks. And last but not least, the targeted subsidy approach. I suppose those we're going to see some delay due to the rising cost of living, so that will not affect your toll players, and so that the monopoly guys will not have to be afraid, at least not so soon. Now, let's go to some of the sectors that I want to talk about, like consumer staples. I think there will be a focus under the new government to reduce consumer burden through various initiatives. So this will really benefit the B40 and M40 household. So consumer staples such as your Nestle, your Power Root, your F&N, QR Resources, Farm Fresh will stand to benefit. Now, I want to put this clearly because not all consumer staples are made the same. So while having said that, it's about looking at companies that have the sort of resilience given the rising cost of living, and of course inflationary, and how it will affect their margin. So you have to pay attention to some of those as well. Now, the telco sector is going to be a bit different because there is going to be a review on the single wholesale network. So this is going to be a bit of concern, especially for the telco players on the rollout of 5G in Malaysia. I think it remains to be seen how the Pakatan Harapan government will work on this. But from what we have learned during the first time, the cancellation of the Singapore and Malaysia high-speed rail, so everything is possible in short. So a bit of risk here to take note of. And streamlining of the recruitment process for foreign workers. I think this is one area that will benefit the manufacturers, your glove players, your construction players, your tech boys, property players as well, because they will help to address some of the labor shortages issues in Malaysia. So if you've been following the market, there is quite a bit of shortage in terms of foreign labor, especially when we open. So this will actually help some of the shortages and help companies to resume their capacity production. Okay, Malaysia, in terms of the top favorites, I think this is basically from our report. You can see that RHB Bank, Genting Malaysia, and Mr. DIY are the three key favorites that we have. Now, part of it is because RHB Bank will be the key beneficiary of the rising interest rate environment. So Genting Malaysia, with the reopening in China, whether it's a full reopening, it's a gradual reopening, it will definitely be better than what it was. So we do expect to see some positivity on their front. And of course, Mr. DIY Group is the stock pick that we have for companies that will benefit from the rising cost. So you can see the target price here that our analysts have. So basically, these are what we have on Malaysia front. So yep, I guess I'll just pass the time back to Crystal.
Thanks, Billy.
Yep.
After hearing all the different views and updates from the different markets, maybe we'd like all of you to just share what are the key risks or areas, right, that investors should look out for coming forward 2023 before we jump into the Q&A. Maybe we can start off with Billy first, since you just ended your presentation.
So, come again?
Okay, after hearing all the different views and updates from the different markets, right? Maybe you all can share with us what are the key risks or areas that investors should look out for coming forward in 2023.
Okay. Yeah, I think unlike the rest of the speakers, I'm less concerned about the market because I do think that there is opportunities in every, I think as I started off saying that when we start of this year, we talk about weapon manufacturers like Lockheed Martin. So it's about looking at the trend that there is and the fact that we are affected by the macro environment. So the key concern will definitely be on the rising interest rate and the quantitative tightening. It is a known risk rather than an unknown risk. I guess for me, that is a sure thing. But what I'm more concerned of is the US-China relationship. I think that is a question mark to me. I think it will signal how the rest of the world will move forward, in terms of the, especially on a lot of manufacturing in US tech companies are also in China, and how all those will be affected. So I think that will play a key risk in my point of view. Yeah. Maybe
Thanks, Billy. Yeah, you can. Who
playing,
would like to actually go next?
because I talk about US and China. So
Yeah.
Okay. Yeah. Oh, yeah, please.
Go ahead. You go ahead. It's all right.
Okay, so for China, I think also like Billy mentioned, the one important risk will be the China-US relationship. If it can be like a stabilized, that will be a very benefit to China's like a open market policy and shift the focus back to the economic growth. And secondly, will be the for China internally, how to gradually open the COVID policy, what kind of progress and what kind of step the government will take, and how to do it, and reduce the overall negative impact will be quite important. And thirdly will be the government's stimulus policies to improve the economy. Like recently, the government announced a couple of the measures to relax the property market in China. That's very important to stimulate the overall economy. So that's the three key risks.
Okay, I think I'll go next. I don't think it's any surprise. I mean, it's a known risk. What Billy was saying is there are unknown risks and known risks, and this is quite clear, at least in the US, that the Fed over tightening and sort of engineering a recession, which is effectively what it's doing, right? So the typical rate cut cycle is the Fed would start cutting when a recession hits, right? But what we've got now is a reversal of that. It's hiking to engineer a recession. It basically wants to engineer a recession for the US economy because the job market is so hot, inflation is so hot. So you're seeing it hike into this cycle of strength, right, for the US economy, which is strange. So I think there isn't really a lot priced in for the fact that earnings are going to disappoint, and they're probably going to disappoint quite badly. But I don't know how deep the recession is, so that is just all speculation. So I think that is the big risk, is that there isn't really a pricing in of a recession in earnings expectations right now. And there should really be, considering that the Fed's raised interest rates by 400 basis points in less than 9 months. So as Jay Powell's alluded to, the lag is maybe less understood from an economic perspective, but we know the lag for interest rate hikes are at least 12 months, if not 18, right? So you're kind of going to see this impact on the US economy into late 2023, maybe early 2024. What does that mean for earnings? I think it's obviously being downgraded going into the last quarter and probably into the first half of this year, but you never know what kind of impact that could have going into the second half of next year as well. So I think there's a lot of unknowns in terms of earnings and how that is going to be priced into the market, because I think at this point, there's a lot of optimism around inflation numbers coming down, which is great, but that's only one part of the job done for the Fed. Where does it end up in terms of the terminal Fed funds rate? And then how long does it stay there? As I said, those are 2 and 3, which are not answered yet. And it seems a little bit too early to get, bullish on the Fed starting to cut in the middle of next year. So I think that's going to be one of the big risks for the market in 2023.
Shall I go after you?
Yeah.
Okay. I think for the REITs, it's really quite a bit about interest rates, because if you look at the REITs even as far back as 20 years, we have never seen this kind of an interest cost and the way it has been increasing on a quarter-on-quarter basis. So it's a lot about managing the interest rate outlook And as Tim says, let's say if the base case is another hike, and even if it holds, even but it doesn't turn down, your interest cost is still going to be elevated, and you need basically one cycle of debt refinancing to get out of it. So I think that's probably where the risk is. And of course, in terms of high inflation, that would erode the operating margins for the landlords because of higher utilities costs, higher operating costs. So those are the things that we basically would watch out for.
Yeah, I would agree with Manyon. I think margins also comes into corporates as well broadly. I mean, costs are going up, right? Inflation's going up. We've had sort of 13 or 14 years of really benign inflation, and it's really been the golden period for corporates, right? And corporate profits and corporate margins as well. They've really been expanding over the past decade or 12, 13 years. And so I think we're shifting into an era where labor is going to have more of the power. You've already seen that the labor market is super tight in the US, but also in other countries around the world. So that gives them, in effect, pricing power on wage negotiations, right? And so you haven't really seen that dynamic in a long time. And so I think this is really going to be squeezing margins for corporates in the US at least. And that really maybe hasn't been priced in over the next sort of 3 to 5 years, because I think the golden age of just ever expanding margins, like profit margins, I think that's maybe being reversed along with globalization and low costs. So yeah, it'll be an interesting 2023 and beyond for investors.
Manya, I think there is questions on your topics for REITs. Land integrated and capital land ascenders REIT.
Yes. Okay, talking to interested shareholders. Okay, but yeah, jokes aside, I think CICT is interesting from the perspective of when we run their numbers, I think interest costs will go up, but I think they also have the ability to grow the top line. As you know, CICT acquired assets earlier this year in Australia, some office buildings. They've also acquired Capital Sky in Singapore this year. So all these rental contributions will come into next year. So that's one, ability to grow income. The second thing is that they've also been completing new asset enhancements like the WeWork at 21 Collier Quay. They've also been backfilling Capital Tower and some other buildings like Capital Spring. So all this will start to really build up their cash rental income, as the new tenants settle in and start paying rent. So from that perspective, I think the ability to grow top line is there, and also to mitigate some of the increase in interest costs. So that's one of the reasons that we like the ability to grow in the near term as well. And at I think about 5.2% dividend yield, not overly expensive, not super cheap, but not overly expensive as well. On Capital and Ascenders REIT, industrials has always been a little bit of a defensive play into, say, a downturn or a recession because of their longer lease expiry profile. And so that's one. And the other is that CapitaLand or Claire is also quite diversified in terms of the type of segments that they're in, whether it is into the science parks, into the other industrial assets, and also in terms of geography into Australia, UK, US, and also to Singapore. So they are quite well diversified, and they've also been acquiring last year using their debt headroom, and all this will start to come in as well. So that's one of the reasons that we like them for the growth prospects.
Thanks, Man-Yi. I think we have a few questions from the floor. Can we take a look at the first question? Do the panelists expect any commercial, economic, or political military tensions to escalate between China and the US? And if so, how would that change the expectations, predictions we have made? Yang Lei, would you like to go first on this one since it's between China and US?
For China and the US, I think, yeah, the trade war has already been there for a couple of years. And especially for some high-tech sectors like semiconductor sectors, I think US has adopted various measures to bottleneck China's development in this sector. And for example, Huawei is on the US list, supply restricted list, and Huawei is short of certain semiconductor components for its further development. So the Chinese government's policy is very clear. The government highly support some like import substitute R&D development, and the government very support the advanced manufacturing industry in China, and encourage these companies to invest in the new technology, new facilities, new machines, and to develop our own technology and our own products, which can substitute the imported products from US or other countries.
Thanks, Yang Lei. Anything to add on, Tim?
Yeah, I mean, I think this is more in line with the general deglobalization trend that we've seen anyway over the past sort of 4 or 5 years. I mean, you have a rising power in China and then the incumbent in the US. And so I think more and more so these two countries are moving away from each other, whereas they've benefited greatly from globalization and obviously China entering the WTO and sort of being part of free trade and global trade. But I think that's on the that's receding, right? I mean, you're seeing that with US sanctions on tech, on high tech, on semiconductors, on China. And then in China itself, they're, you know, the 14th five-year plan was talking about dual circulation, you know, promoting greater self-reliance and being a bit more, you know, like sheltering themselves from the volatility globally, right? With the likes of the US imposing sanctions. So I think all these things are going to continue. I think it's going to be periods of detente, and there's going to be talk about this is going well. And you know, there was Xi Jinping with Biden, and they had a great chat at G20. But I think the general consensus or the general sentiment is it's going to be moving toward more negatively over the next, you know, decade, and that's just the function of both countries maybe feeling threatened by each other. In terms of expectations and predictions, obviously the big elephant in the room is Taiwan, which is what a lot of the tension is between the two countries. And I think if it's military tensions, it's going to be based on Taiwan. In terms of high tech, the US is already starting to impose sanctions on certain chips. We've seen that. In terms of Taiwan, I mean, there's a lot of talk about Taiwan being home to what, 90% or over 90% of high tech chips or cutting edge chips that are manufactured. Obviously, TSMC owns 95% market share of that sector. So you're seeing a lot of investment into Europe now, into the US. I think just today TSMC upped their investment into the Arizona plant to $40 billion. So they're going to be building, you know, a fab. They're going to be building a complex there in the US. But it doesn't really, yeah, I think it's really difficult because it's all just talking about the potential scenarios of what would happen. I mean, there's a lot of war games that the US government have carried out with what would happen if there was a war in Taiwan. And then from the Chinese side, there's a lot of talk from nationalists saying, oh, if we just take Taiwan, we can own the global semiconductor supply chain, and we'll have, but it's simplifying it too much, right? I mean, the global semiconductor supply chain it's so global, and it's not just focused in Taiwan. You have suppliers from the US, you have ASML in Europe. So the things that go into these chips are global, and just having Taiwan is not really going to solve anything for China. So I think it's going to be very volatile, I think, for both China and the US. In terms of where it goes for markets is anybody's guess. Nobody can say for certain. So I would just say it's not heading in the right direction. That's all I would say.
Thanks, Tim. Liam, do you have anything to add? You look like you want to speak.
Yes, I'm okay with the answers. Yeah.
Okay, sure. Let's take a look at the next question. Okay, this is directed to Mani. Okay, it seems like the inflation has peaked and Fed has turned dovish. Is it time now to rotate out of banking sectors and back to REIT sector to ride the uptrend in the share price?
Thanks for the question, and it's a great question. I think in the scenario that inflation has peaked and the Fed turned dovish, then yes, basically looking to rotate out of the bank and potentially into the REITs. In fact, today, I think the research, one of our banking analysts has issued a report basically downgrading banks to a neutral position. I think the fact that the Singapore market, 40% of your index comprises of the banks. So, unless you're very bearish on the index, you would kind of like maintain a neutral position. The bank that we still like is basically UOB. We have downgraded DBS to a hold. When you rotate out of banks, where do you go to? I think certainly REITs has been one of the sectors that people have been talking about. But my take on it is that no need to rush because I think if you look at the upcoming results, I think potentially we might see a bit more earnings cut coming through, whether it is in terms of the higher than expected interest costs and things like that. So I think, yes, agreed in that strategy. Watch out for opportunities to get into the REIT sector.
Thanks, Mani. Let's take a look. Sorry, Tim.
Yeah, I mean, Mani, if Fed funds rate go higher than expected, isn't that like an upside surprise, maybe to banks' earnings? That was just my take. I think like right now we're pricing in 5%, right? But what if it goes to like 5.5 to 6, and we stay there for a while? Is there like an upside surprise to earnings for banks?
Yes. Yes, I think, okay, so so our base case is still that we expect one more rate hike probably in the first half of 2023, so target 5%. If, let's say, inflation is so stubborn, it goes to 5.5%, then essentially this trade of rotating out of banks into REITs will probably take longer time to pan out, because as it stands, because of the lag effect on the net interest margin of the banks, if rates continue to rise, then instead of peaking in, say, first half of 2023 in terms of the NIMs, then you may see that going higher for longer. So that would, I would say that would probably be where the downside risk for the REITs are and the upside risk for the banks under that kind of scenario. But our base case is really that for now is looking at a target of 5% interest rate as far as the Feds are concerned.
Okay.
Thanks, Mani. Let's take a look at the next question. Which market will be leading the market recovering? The US or the China? Tim and Yang Bei?
Well, I mean, to be honest, I think China's gonna come out of it in the immediate future. You've already seen the rally, right? But it has to continue to open up, and I don't think it's going to be an overnight thing. I think it will take time, you have a massive population. It's, you know, we've seen the vaccination rates and we've seen the intensive care beds per 100,000. So I mean, these are all questions, but it's that in terms of the consumer recovery, I mean, I think China will lead that coming out of COVID-0.
I agree. Actually, based on other countries' experience, I think from the government announced to open to the real COVID return becomes normalized, it will take like 6 to 9 months this period. So from now, the Chinese government start to open, and we only expect the real economy and the real domestic consumption will come back in second half next year. So it still takes time.
Thanks both. Let's take a look at the next question. Can you share why the top picks in the internet services sector in second December report is PDD, Meituan, and Tencent? And would the relaxing of COVID measures in China be negative for Meituan, as less people order meals online, and negative for PDD and Tencent with less demand for online services?
Yeah, like we just discussed, from the government announced the policy to relax to the real COVID situation to smooth. It still takes more than half a year. So during this period, people still will quite rely on the online platforms to meet their basic needs, like drugs, meals, FMCG products during this very, I would say, very volatile period. And secondly, even after the COVID period, I think people will establish some consumption behavior, and that they will find that the online consumption, online platform is very convenient. Like for older people, previously they quite often go to the offline hypermarkets, supermarkets to buy grocery stuffs, but now they find different online platforms for them to buy the groceries, which is quite convenient, very quick, and the product quality is also good and also relatively cheap. So I think this kind of consumption behavior maybe will be sustainable even after the COVID. So this will continue to benefit the online players. And why we like PDD, Meituan, and the Tencent. For PDD, it benefits from the increasing brands and the merchants to join the platform, and the increasing shopping frequency of its users. And also PDD actually benefits from the consumption downgrade in China, because PDD traditionally is very strong to provide value products and agriculture products to consumers. So when the consumption power and disposable income is relatively weak in China, more and more users actually penetrate into the PDD's platform. And for Meituan, they will definitely benefit from the food delivery order value to increase, because more premium restaurants actually get online. And also they will benefit the faster growth of the instant shopping business, because currently the instant shopping for drugs, for flour, for snacks, for lots of different stuffs increasing very quickly in China, and the online penetration rate is still relatively low. So Meituan has already set up its own team and connect with lots of offline stores for its instant delivery business. And we expect that this part will be a new growth driver for Meituan. And for Tencent, we expect its online game business will recover next year, along with the government's regulatory environment towards the gaming sector is normalized. and also along with the China economy to improve, and Tencent's advertisement revenue will also recover. And also people have high expectation on Tencent video content. This is a new function in the WeChat, and because the videoized and the live broadcasting is very popular in China, together with the faster growth of Douyin and the Kuaishou in China. So people think this is also very important faster growth and monetization way for Tencent.
Yeah, I would also add, like, I mean, for Alibaba, I think there's a lot of chat out there about it being cheap and everyone loves it. But I think they've really like sat on their heels. They haven't innovated, and they've allowed like Kuaishou and Douyin to like basically eat their lunch. And then there's talk about the cloud, and we've seen that the government is going with government vendors for the cloud. They don't want private vendors because of internet security, IT security. So there's a lot of growth drivers that they thought they had, and they still are a huge asset. But I think the growth days for Baba are pretty numbered. And you've kind of seen like Meituan and JD has really executed a lot better than Alibaba on the e-commerce side. And so that's why I think, yeah, I mean, I agree with Lei. I think like Meituan is like going into grocery. It's also doing a lot in travel, online travel. So I think if it opens up, I think they'll also benefit on the travel side as well. So yeah, so I think it's something to keep in mind. I think these upstarts, like this tier 2 like tech firms in China, are really challenging like the big guys. So it's an interesting dynamic.
Thanks, Tim and Lei. I think I agree with you, Lei, because over these 2 years, right, I think we lose some sort of reliance on the convenience that online services have actually provided. So even for me now, right, I also rely mostly on like the delivery services that is currently available, even though we have actually opened up compared to the last 2 years.
Yeah. I think some shopping behavior, consumption behavior has already been changed.
Correct, that's right.
Yeah.
Let's take a look at the next question. How do you foresee the trend of commodities, for example, crude oil, palm oil, metals in 2023? Okay, maybe this one, Billy, would you like to take on this question?
Yeah. I think that we should see some, if you ask me, I think we should see some stabilization after what we have seen this year. So I think there would be a bit of moderation instead of a continued rally in oil prices. I think we have seen that it's gone up quite a bit and it has come down. I think I'm not sure what's the recent prices, but it came back down to below 100, and I think it should moderate slightly at this level, despite the reopening of China. I think that mostly if you look at the reason for oil prices to remain at this level is more to do with supply rather than demand. So I think that it's something that can be changed when there is a need for that. So yeah.
Thanks, Billy. Anyone has anything else to add on for this question? Tim or Lei? Lei, would you like to go?
Yeah, for the palm oil, actually, it's a very important raw material for some consumer staple companies in China, like instant noodle players, Tingyi, Unipresent China, and the rice cracker player Want. And actually, the palm oil price has already started to correct since July this year. And it has been reduced by like more than 20% from the peak. So basically, these companies has a view that the palm oil price will be at least stabilized or to further reduce for in next year, so that their cost pressure will also be reduced, and which will benefit their margins. Yeah,
I would say on the oil side, there's a lot of chat in the in the press about the oil price cap on Russia, and there's still ways for Russia to get oil out, and they're selling a lot to China or to India. And the supply is still very constrained for oil. And as we know, we still need oil to function, oil and gas. I mean, you've seen the prices of oil and natural gas go up. And so at least in the US, oil producers are pretty disciplined. They're not spending a lot on capex. They're paying out a lot in dividends, and they're carrying a lot of share buybacks. So they have a lot of cash on hand. So, you know, a lot of it, I've seen the case made for investors that it's a good sort of 2 to 3 year trade in terms of cash flows. But obviously longer term, we know the transition to clean energy is coming. But in between that transition, there's going to be a lot of disruption, and I think it's going to see commodity prices, at least like crude oil, stay pretty elevated. But other prices, you know, that it'll be very different. It'll be a very dispersed, like this. There'll be a lot of dispersion between commodity prices.
Thanks, Tim. I think we have a few more questions. Let's take a look at the next one. Okay, this is on China. What is the white paper uprising in the public? And the second question is US-China trade dispute has been 4 years. Very limited impact is seen. What is the impact to high-tech semiconductor producers?
I think for second question, it's quite related to the previous question I have already answered. Yes, I think the US-China trade war has already largely impacted the semiconductor producers in China, like Huawei, and they are kind of short of some semiconductor components. So that's also why the government focus is to encourage and develop, encourage the companies to develop advanced manufacturing technologies in China, and to develop more products and components which can substitute the imported ones. But it will take time, especially for the semiconductor sector, because the R&D cycle is very long. So I think it takes time. So I think between China and the US, actually a win-win situation will be a better solution, which will benefit both countries. And for the first one, yes, like 2 weeks ago, we have some, yes, white paper uprising, the public events in larger cities like Shanghai, Beijing, Chengdu, Chongqing. I think that's mainly due to the zero COVID policies actually impacted the people's daily life, and lots of people's disposable income is also quite negatively impacted. So people actually just want to raise their hand and let the government know they want the policy to change. So actually all these public events happened right after that weekend. The government announced the new COVID-20 new COVID policy measures, and actually speed up the opening process. So in the next couple of days, we expect the Chinese government will announce further relaxation policies, another like 10 new measures. Maybe the whole reopening process will be quicker than people expected before.
Thanks, Lei. I think we have a few more questions coming in. Can we take a look at the next question? How about bond market? Is it time to buy some bond now? Maybe Tim?
I mean, bonds, to be honest, they've had a pretty bad 2022 along with stocks. I think it's because of the unique circumstances we find ourselves in. I think I would be getting more constructive on bonds when it's pretty certain that the interest rate cutting cycle, you know, is going to start or is going to begin. But at this point in time, there's like not really any certainty when the Fed is going to start cutting. It's just assumptions that they will start cutting in the second half of next year. So there's a lot of market expectation that bonds will do well next year, but that's premised on the assumption that the Fed's going to start cutting, right? And that will benefit the bond market. But on that, sort of assumption, I wouldn't be super optimistic. So for me, I'm not that constructive on bonds right now.
How about Billy?
I think it should be better in 2023. Yeah, I do agree with Tim that there's still a lot of uncertainty on that front, but I guess there's only this much you can raise interest rate before the market fell into a deep recession, I believe. So we can talk about there's still a lot of uncertainties, but you can go 50 basis point, another 100 basis point maybe, or 200. It's around that range you can't go. So it's more or less something that people have expected it to be. So I do think that since it has done so poorly this year, which is a surprise, but I'm expecting it to be better next year. So yeah.
Thanks, Billy. We have a question from Mani. Has the relationship between increase in Fed fund rate and REIT share price also broke down? If the Fed moderate, then stock increase in rate and even rate cut towards end of 2023, does it mean that REIT share price would also drop correspondingly?
Okay, in terms of the relationship between the Fed fund rate and also the REIT share price performance, I think when we do a study just comparing the Fed fund rates versus the share price, the relationship is not so strong. But what we found was a stronger relationship or a correlation was the fact that the yield spread has an inverse correlation between the share price performance of the REITs. Means the wider the wider the yield spread, then the share price should improve. It looks as though it has broken down for now. I think partly also because inflation rate persists to be very high. It's way above the stress level of 3.5% to 4%, and it's still quite high. So I think once we see inflation peaking, we think that that would mean that also your interest rates trajectory should also tone down, and that is when we think that the REIT share price performance should come back again. So it is not just probably one factor, but a couple of factors put together as well.
Thanks, Mani. Can we take a look at the next question? This is for Billy. What are the advantages, opportunities for investing in Malaysia Bursa companies compared to US or China? And I think your last slide, would you be able to share it again? I think some of them missed it.
Yeah. So just go with the first one first. So basically, I think there are quite a few. Like I mentioned earlier when I started the slides on Malaysia, I said that Malaysia is more affected by the political risk than the macro environment, and I think that's the case. And if the political environment in Malaysia were to remain stable, I think that there are quite a few opportunities in the Malaysian market. Basically, if you know, there are a lot of semiconductor players in Malaysia. So I think we talk about the deglobalization due to the US-China relations, and I think this will benefit a lot of the tech players in Malaysia, which will probably be benefiting from those who wanted to use ASEAN manufacturing hub as the place instead of everything in China. So that's one of it. I think another one is, of course, we have quite a bit of oil services companies listed on Malaysia. That's also another upside, given that we have an expectation that oil price would remain fairly stable next year. So I think that's going to benefit the Malaysian market as well. And of course, if you look at the structural issues in Malaysia, and if those issues were to address, this will also lead to a lot more confidence for foreign investors to come into the Malaysian market. So I do think that we have the Bursa Malaysia market especially has already seen a bottom as compared to the rest of the region. If you look at the last 5 to 10 years, I think the Malaysian market has lagged behind peers like even Singapore, which is a surprise. There is usually a premium packed to the Malaysian market for the political stability in the country. So I do think that there would be quite a bit of advantage as compared to the uncertainty that there is in US and China. in terms of the last slide, just let me share. Okay. Yeah, can you see the last slide? Sorry. So basically, as mentioned earlier, the three favorites are RHB Bank, Genting Malaysia, and Mr. DIY. So for RHB Bank, I think I mentioned earlier that is the biggest beneficiary of the overnight policy rate hikes among the large Malaysian banks. And of course, at a dividend yield of 5.3%, it is fairly attractive. If you look at Genting Malaysia, there is a potential rebound. We talk about the reopening and the recovery phase. So that's really what's going to drive the market for Genting Malaysia. Of course, there is also a potential win in the New York downstate full casino license. So that will also be another potential upside. For Mr. DIY Group, I think it will be a beneficiary of the down trading trend amid rising inflationary pressures. I think we talk about that. So the new store openings in Malaysia is going to continue, and we will see more profitable sales mix and higher SSSG. So generally, in a rising inflationary environment, consumers tend to look for best deal, best value kind of products, and Mr. DIY offers that. So this is part of the reason why it's in among our top pick. Yep.
Thanks, Billy. We have last two questions. Can we take a look? Okay, there's one more coming in. Okay. For Russian oil to export, they need insurance. For sanctions to be effective, will Russia get insurance when West control most of insurance? Not sure, Tim, if you're able to address this question. Insurance.
Insurance, like oil insurance, is not one of my specialties, but
is there
I would
anyone
just say,
who is more familiar?
I don't know. I would just say that this is just an example of what we're going to see more of in future anyway. The West will fear the US. I mean, we say about the West, but we mean the US will probably weaponize things like, the financial system, the dollar, and they will get a consensus among European nations and other allies to do this. I mean, for Russia, it's not that. I mean, in terms of the global markets, it's really not that concerning. I don't think any of us should be that concerned. It would be more like this is the signal for maybe if they did this to China or did something that would be very concerning, because then it would be a much bigger impact. I'm sure like Vladimir Putin wouldn't want me to say that, but I mean, Russia is really quite insignificant to global markets. But so I don't have expertise in this, but I wouldn't be too worried as an investor.
Thanks, Tim. Let's take a look at the next question. 2023 incoming unicorn industry. Maybe this one I direct to Billy first.
Sorry, I don't really know.
Sorry?
I don't really know on this. I don't have a comment on this.
Okay. Anyone else has any comment on this? Mani, Lei, or Tim? Okay, I think this one is quite a difficult question to answer. Maybe we skip to the next question. The strong US dollar has been a major driving factor of the equity and bond market in 2022. If US dollar is expected to weaken in 2023, does it imply fund flow would come back to Hong Kong and Singapore market? Tim.
Yeah, well, I mean, the US dollar has just been strong mainly because it's the least bad option of the global currency markets, right? I mean, it's not because the US economy is so great. It's just in times of volatility and headwinds, the US dollar is a safe haven, so people flock to it, right? I guess in terms of the economy, it's doing a lot better. If it does continue to weaken into 2023, I mean, long US dollar, USD is probably one of the most crowded trades. So if there is a soft landing, if there is a tapering of inflation at a lower level, and the Fed manages miraculously to avoid a recession, then I think there will be flows going back and the US dollar will continue to weaken. But those are big ifs at this point. Singapore dollar has done actually relatively well this year. It hasn't actually weakened that much. And Hong Kong, we know, is pegged to the US dollar. And they've had to raise rates. I mean, the Hong Kong economy is in big trouble because its monetary policy is effectively tied to the US, right? And whereas the US economy is red hot, the Hong Kong economy is down in the doldrums because of COVID. And so it needs to start opening up quickly because the banks there have needed to raise rates into an economy which is really not good. So if it does continue to weaken and into next year, then I would expect fund flows into Singapore. I think Hong Kong, it would really rely much more on sentiment for China stocks and also how the economy in Hong Kong is doing. But if China reopens, as it looks like it will, then I think this could be something that, yeah, there could be flows in the next 6 to 12 months.
Thanks, Tim. I think we are running a bit late right now. Maybe we take last two questions on the Malaysia market. Will Malaysian semiconductor benefited from US chip fall on China? And I think there's a second question on Malaysia as well. What is the opinion of technology sector in US and Malaysia?
Sorry, what's the last question again? What is that?
What is the opinion of the technology sector in US and Malaysia?
Okay, so basically, yeah, like I said, I think Malaysia will be one of the key beneficiary. I mean, there are a lot of factors. I think just on the previous question as well, the weakening dollar, I think that will also be beneficial for fund to come into Malaysia as well, because ringgit has weakened for so long against the dollar. And so I think it is going to be a turnaround for the Malaysian market, especially the tech sectors as well. Of course, we all know that there is also the bigger picture to consider, right? The macro picture, which, how the US, the interest rate hike and how that will affect demand and all that. But I think in the longer term basis, I think Malaysia semiconductor will be in a very good position to benefit from this geopolitical divide between US and China. So we saw that there's a lot of US has this US Chips Act that gonna, I think 52 billion subsidy, and the European will going to have their own chips as well. But even with all this, it's not going to be enough for them to create a manufacturing hub that is cheap enough, that is efficient enough, unless of course, automation can really come into play in a nearer time frame. If not, I think Malaysian will definitely benefit from that, especially our semiconductor players, which are known for their efficiencies and all that. So in terms of the tech sectors in US and Malaysia, I think the US is a bit more risky due to the valuation. But aside from that, on a structural growth, like I talked about it earlier, I think that it is going to continue, the digitalization. So people are still going to turn into, like we talk about going to using delivery services and all that. All those would require your cloud services, your infrastructure. So the players like, Microsoft and all that, they will be there. So I think in the longer term basis, they will benefit, but in the shorter term, I think that their valuation will hit them and that they will be affected. Meanwhile, for Malaysia, I think most of the stocks have come down quite a fair bit already. And I think that most of the negative news have been priced in. And barring anything that, as long as things remain stable politically in the country, I think that we would see a turnaround in the tech sector for Malaysia.
Thanks, Billy. Tim, anything to add on the tech sector in US?
I would just say that I think for high growth tech, it's a very different environment, macro picture wise. So even for big tech, I spoke about this a few weeks ago, actually, with the hiring that we saw at Meta and Google and Amazon as being a bit undisciplined during the pandemic, and they hired just way too many people and got ahead of themselves. And you've seen the public sentiment really turn against a lot of big tech players and founders in the US. I think with larger, sort of more established tech players like Apple and Microsoft, they've held up pretty well. And they have continued to outperform, the Googles and the Metas and the and the Amazons, mainly because there's a bit more accountability from management teams. There isn't as much power concentrated in founders. So I think with FTX, all the news we've seen from founders and all the trust that VCs have put into founders, and founders are good for companies that want to grow, and tech is one of those high growth sectors. But the age of the Messiah founder, I think, is starting to come to the end, because now it's about responsible, constrained spending, discipline. Cash flows are king. Free cash flow is king. And that's going to really exclude a lot of tech companies that have just been burning cash for about a decade and still not got any profits. So, there are the big guys in the US who are profitable, and they've been around, and Apple and Microsoft have proven themselves, and they continue to do very well. But I think other companies will be disrupted. And so it's something to watch out for investors. I think it's going to be a changing landscape for investors in tech.
Thanks, Tim. Thanks, Billy, Lei, and Mani for tonight's session. I hope tonight is a fruitful one. Yeah. Do hope that you can actually help us to do a little short survey by scanning this QR code. Thank you all, and good night, everyone.
Okay, bye.
Thank you.
Thank you.
Bye-bye.
Bye, everybody.
Bye-bye. Bye-bye.
Bye. Bye.